Hello and welcome to Questioning the Manager. Today we are joined by Ben Lofthouse, who's the fund manager for Henderson International Income Trust. Ben, thank you for joining us today. So we're firmly into the second half of 2018. So can you give us your assessment of the year so far?
So it's been a fascinating year this year. A lot of the trends from last year in terms of economic growth have continued. So the US has continued to be strong. Economic growth in general has continued to be, recovering, and I think that that's caused some changes that we had expected, such as interest rate expectations increasing. The US in particular has carried on increasing their interest rates in response to the growth. I think there have been some notable surprises. Two large surprises. One has been the US tax cut. This is a cut which makes life a lot more profitable for US-based companies with domestic earnings, which people focus on, I think, less than the fact it also has a repatriation element for overseas dollars. So actually, we are seeing strong earnings growth from the US, partly as a result of this tax reduction, which is significant. And the other big surprise, I think, is the extent to which politics has acted as a destabilizing force on the markets. So against this background of relatively good economic growth, we've had probably two and maybe three significant events. Firstly, the President of the United States has been much more forceful than many of us expected on trade. And this has caused not any direct impact so far, but certainly has caused areas like regions like China and Asia and Europe to some extent to underperform because they are quite reliant on trade. And also the thing we've seen is that we had an Italian election which resulted in two parties that weren't expected, and some of their communication has led to significant uncertainty again around Europe. And so we've seen Europe, although the economies have been growing okay, we've seen destabilization in European stock markets, particularly in financials. So, underlying things have been quite good, but actually, the sentiment-wise and in terms of political news-wise, it's quite a tough environment to sit with.
Okay, and have you made any notable changes to the portfolio list? Have you been topping up any positions or trimming them down, for example?
We haven't made any particularly large changes to the portfolio this year. The United States is the biggest exposure that we have, and so we've been pleasantly surprised to see the reduction in taxes there, which has been beneficial to a number of our companies, and we're seeing good earnings growth coming from there. Earlier in the year, we had reduced some of our exposure to companies that have performed particularly well over recent years, particularly some Asian growth companies, and we'd taken some profits there. So not really as a result of macroeconomic worries or concerns or changes, but more as a result of valuations. And then in the recent sell-off in some of the European stocks, we have added to European stocks over the last 4 to 5 months. We think they do exhibit very good value, particularly to maybe global stocks that are domiciled or listed in Europe, but actually are quite global. We see those trading at quite a big discount to their peers elsewhere.
Now, the portfolio doesn't use the gearing facility, or it hasn't used it for some time. Under what circumstances would you consider leveraging the portfolio?
Yeah, so at the moment we're not using the gearing facility. We have been very active with gearing in the past. In general, we use gearing in a counter-cyclical manner, and so when we see markets selling off significantly, and we think it's and periods of volatility that we think things are overdone, we've used the gearing to invest in the portfolio and in new opportunities as they arise. I think for the moment, we've had quite strong markets for a few years, and we've got a lot of political noise, as I discussed earlier. I think we'd like to keep a bit of powder dry just to make sure we have some room to take advantage of opportunities if they arise. It's not my base case that it arises, but I think there's definitely opportunities, maybe not at the complete market level, but it could be in specific areas and sectors as a result of trade discussions.
Now, interest rates have been going up in the US and most recently in the UK, meaning that the cost of borrowing has gone up. How would that affect your strategy with regards to gearing?
I think what you find is that in terms of gearing, the changes to the financial characteristics of a portfolio or the income characteristics as a result of interest rates changes that are small tend to be insignificant. So, the benefit that you get from being geared in a rising market would outweigh the additional cost of gearing. And in the same way, if markets fall significantly, the lower cost of gearing that you might get for interest rates going down don't really help you as much, anywhere near as much, as the impact of the falling net asset value. So really the interest rate decision from these levels isn't particularly material, particularly because quite often when trusts borrow as well, some of them do borrow longer term, and so some of them have locked in their gearing and they are less sensitive to it.
And finally, what's your outlook for the remainder of the year?
Yeah, so for the remainder of the year, what I can say is we're meeting a lot of companies that we own and that they're reporting at the moment, and generally the trends are good. So, some of the volatility that we're seeing within the market, and particularly within this country, some of the sentiment, uncertainty around something like Brexit is not necessarily playing out in a lot of these global companies. They're generally seeing the conditions to be quite benign and in some parts of the world improving. We've seen some very good dividend growth coming through from some of our holdings recently.
Ben Lofthouse, thank you very much for joining us today.
Thank you.